Thought I could get a swig in. Let's check the audio before we get started here. Audio looks good. Fantastic. How you doing, friends? This is Coach Ernie, and this is the 0DTE morning market analysis. I know I haven't been regular with the market analysis over the past week or so. That's because the wife and I took a little excursion up to PEI, Prince Edward Island, via Bar Harbor and St. John, and had a wonderful time. Took the dogs with us. But now we're back, and it took me a couple of days just to get back into the swing of things. All the while, I was still working with my my coaching group, but it was just not enough time to do a morning analysis with all that beach walking and everything. Prince Edward Island is a beautiful place, but quite frankly, I love it here in the good old USA. Especially in the Massachusetts area where I live, and the beaches here. I don't know. Doesn't hold a candle. Anyways, that's just me, recapping. Let's talk about the markets. We are hovering at all-time highs, but this isn't the calm. It's the calm before, the proverbial storm. And we're not in balance either. We're in a kind of a compression. It's a volatility seedbed that's forming just beneath the surface as the SPX grinds into a kind of a tightening coil. And I'll show you that in a moment. And we've hit all-time highs, yeah, sure. But inside a dwindling range, have you noticed that the range is just going, decreasing realized volatility, and a VIX at 1529, that's whispering not stability but fragility. And that's really what we play off of. The S&P has pushed to new highs 3 days in a row, yet under the surface, the structure is definitely tightening. Now, what the hell am I talking about? Well, we do a wide range of strategies that are all based on one principle, and that is tail risk events are going to happen. We also take extremely low risk for large potential outcome, and what that results in is equity curves that are super tight. And when I mean super tight, I mean Sharpe ratios above 5. In fact, the most recent account that I just started about 35 days ago has a Sharpe ratio in the 7s. That is unheard of. Now, will I be able to maintain that? Probably not, but my average is still around 5.5 or so, which is in godly territory, I must say. I want to point this out only because our strategy makes money consistently while keeping the volatility of your returns super low and tight with hardly any drawdown. And that's the way I'm sure everybody would love to trade, never feeling that anxiety. So while it might seem a little boring to some, it's not that 20, 30 trades a day and getting in there, momentum, and just getting all that ire up. We don't do that. We make, and we're not sitting here trying to predict the markets. We position ourselves for these type of events, and that's exactly what is building up right now. That node that is forming right now is sort of accentuating a shrinking range. Now, volatility is sitting very quietly. The VIX is at around 15.2, I think. That's in zombie land. We call it zombie land because, man, it feels like you're running through the mud. You're running after. What's the thing I used to use? Zombies are chasing you, and you're running through the mud. That's kind of like what it feels like. And of course, this isn't stability. It's suppression. It's compression. And this is kind of fuel for future volatility. You'll notice if you look at the VIX, every time it comes down, and meets some bottom, it's then met with the next surge of volatility and goes up and then comes down, and then goes up. Every time it goes up like that, that's where we're making bank. When it's coming down like this, we're not losing any money. So sometimes, though, when you get into these volatility suppression regimes, it can go down for a long time. And in those cases, we're banking on our longer-term plays. So our short-term plays, like the 0 DTE, when we get those spikes, they pay off big. And when they're not paying, they are, virtually no or very little loss, very slow bleed. And then as we get those longer dated moves that move fairly, in great magnitude, I guess you could say, those come in the longer day trades. Instead of a 0 DTE, we might go a 5 DTE or even a 10 DTE. And then those make bank. And when they're not making money, they're also just slow bleed. So when you combine the two, you get this great equity curve. And that's what I want to show you. So while volatility is really compressing, there are two competing forces that are converging. On one hand, we have the basic narrative. Earnings season's heating up earnings season will be coming up next week with Microsoft and Google. Rate cut odds are being repriced. The Fed fund curve and the FX volatility is starting to leak from Japan's intervention chatter. On the other hand, we have a structure, tightening price memory, volume wells just overhead, and a VX curve. That's the VX futures, the VIX futures. That's starting to flatten. These signals don't whisper. They are basically forming kind of a coil. All right. I mean, this is really the bane of most traders. They get comfortable in a time like this, and they feel like they can just play that momentum. Then all of a sudden, everything breaks, and those high probability strategies that they put on with huge risk come to bear. So we're not looking at balance right now. We're looking at a setup. And when price compresses at highs into low vol, it's not a matter of if we break, it's how violently we do when it happens. So the question today isn't whether to chase the trend. The question is, are you positioned for the next move or stuck in the comfort of the last one? That's what I got to know. So let's first start by taking a look at what's going on in the market, and we'll go to our trusty trading view. Well, here we can see the NDX. Actually, I'm going to be playing the NDX today, by the way. The NDX has about anywhere from 5 to 15% more volatility than the SPX, and so when you have these low volatility times, playing a slightly higher volatility index pays. And so even there you can see the compression. But let's go back and take a look at that compared to the SPX. Here's the SPX. And very similar look. But you can see as we're getting to these all-time highs, we're really starting to compress. We had a nice move up here in early July. And then some more consolidation and another breakout where we're at now. Yesterday was very, very little range. And I expect, the same thing to continue until it doesn't. And that's our setup. So each one of these tails that you see here that happen, those make huge money for us. And while these steady moves up like you see here, they make money. When I say huge money in the short-term DTEs, the 0 DTEs. And then these moves like right here, they make money for us in the longer-term DTEs. So no matter what the market's doing, we're there positioned to take advantage of it. But let's go to the VIX and see where we're at with our 0 DTE trades today. VIX is at 15.29. We are definitely in zombie land. That means we're looking at 20 to 30 wide on our SPX trades and our E-mini S&P futures trades. We're not yet into time warp territory because we're not getting those huge overnight moves. So I don't see any reason to do time warp. Time warp is a variant of the 0 DTE where we go out 1, maybe even 2 DTE. Instead, we have another strategy that we call the convex stack that is designed specifically to go from 2 to 5 DTE. And so those are the type of trades that we're playing. And while it's very similar to the 0 DTE trade in that we're looking for, we're looking at the volume profile and we're looking at market direction and we're looking for events that are happening in the economic calendar, it is pushed way further out so that the risk that we're taking on, say, a 50 wide, we might buy a 50 wide for like 60, 70 cents. And those trades pay. They pay big. And that's I want to show you that in a second here. But let's continue with the analysis. So we know how wide we want to be. We're narrowing up our flies. We're looking at a directional bias that is still bullish. Now, just because we have a directional bias of bullish doesn't mean that the market might not go bearish. In fact, we're not sitting here trying to predict. We're simply choosing a direction so that we know what kind of trade we're putting on. And in a bearish market, in a bullish market, if we get a pullback, we can still make money on a bullish move, believe it or not, because we're waiting for that pullback. And when it happens, we put on our bullish move, and then often we'll get a retrace and make money on that. So the choosing of direction really is more of a statistical thing. We know that trades that go, or days that go in the direction of the trend on magnitude tend to be of greater magnitude than the counter trend moves. And so by going with the direction of the trend, we're more apt to pick up those bigger moves. So that's why we do it, at least in 0 DTE. But we can make money in both directions. In fact, we do. So this is the last week of trading. Each one of these vertical pair of blue dashed lines are indicating the morning session. This is Friday, and then Monday, Tuesday, Wednesday. No, I'm sorry. This would be, this here is today, Thursday, Wednesday, Tuesday, Monday. So it's the last week, right? And so we had this breakout from the consolidation here on Wednesday, and here we are on Thursday. So as an example, our 0 DTE trades, this would have been a strong 0 DTE trade that I did make right there. So we're bullish, but it pulls back. It starts out bearish and then moves up. And the same thing on Tuesday. Here's a pullback right to a structural level. See, these structural levels, what we're doing is we're mapping out the volume profile. All right? And so something like this happened before the market even opened yesterday. So similar type move. A 3 DTE or 5 DTE move might be something that we take here for today's expiration. In fact, I have such a trade on, and it's currently poised. So and it's kind of a Batman. It's both above and below. And so if the market does a sharp move higher or breaks out, that's going to pay. I think it cost me 50 cents, and it's a 50 wide. So in other words, I paid $50 for a trade that has about $4,950 of potential. And that doesn't mean I'm going after that pin trade to get that. It would be nice, but that's kind of a low percentage thing. Even if it comes close to my butterfly, I'm still on that $50. I can still make a $1,200, $1,300, $1,500 trade on $50, right? And I'll show you. And just to prove the point, I'll show you that right after we finish our analysis. So here we are at all-time highs. This is the profile, sort of zoomed out a little bit. Yeah, and take a look at a bigger picture here to the beginning of the year. So we definitely are in lower volume territory, nosebleed territory. So anything can happen, and anything will happen. All right, so let's take a look at the current, my new account. Now, all these accounts that I'm going to show you are accounts that I trade in my coaching service. They're intentionally kept at a lower amount, let's say lower capital amount. This one I started at I think $83,000 or something, or $85,000, and the previous one something similar. And then there was another one I started at around $25,000. But I want to show you the performance. That's the important part. I also have a much larger account that I'm trading similarly at a much larger position size. Let's see. Let's start with the current strategy. Sorry, I have to get it up in front of me so I can see it too. So this is this month's, I just started, this is a tail risk strategy. We're trading 0 DTE as well as 3 to 10 DTE. And it's not a huge number of trades, total trades 28. But, you know, in 1 month, we've got about a 5% return. And here's the important part. Look, win rate only 42.9%. However, the Sharpe ratio is 7.36. I want you to go and look up or ask your AI, what does it mean when a trader is trading a Sharpe ratio of 7.36%? And if you think that's an anomaly, I want to bring you back to some of the other previous ones and bring you back to this one here, which is... Now this one's showing about 100 trades over a span of about a quarter. And you can see, again, very tight performance with a Sharpe ratio of 5.25. Win rate's a little higher on this because we were choosing a... it was a very volatile time, so we were choosing big-ass flies, which are at-the-money trades a good deal of the time. And so they tend to be a higher win rate. So we adapted to the market conditions, but still the same kind of performance that you see there. Made in that period of time made 24%. Now the important part is, well, what does that mean over the course of a year if I kept on trading like that? And we can see that by going to the log and then looking up here at our SAGAR, our compounded annual growth rate. If I kept on trading at this rate, it says I'll be doing about almost 78, almost 80% for the year. So let's take a look at another example. Another example that we're trading, and that is this guy here. Again, very similar result. Nice tight profile. This is significantly more trades. This is almost 460 trades. And it was over the course of about a year and a half, but returned 114%. Its SAGAR was 113%. So I'm consistently in, either 70% return to 100% return, for the course of a year. Now, I'm sure you'd love to be able to trade that way. And let's see, going back here, you'll see that my Sharpe ratio, 5.87%. Again, I want you to look up Sharpe ratio. Now, my average risk to reward here was 1 to 10, right? So that was mostly 0 DTE trades, almost all 0 DTE trades. Let's go on to the one that we just showed you. And that is this guy here. I don't have the average risk to reward on this one, but I can tell you what it was. It was about 1 to 12. So that one is pushing things a little bit further out, doing some 3 to 5 DTE trades. doing more trades and just pushing them further. Even on the 0 DTE trades, we used to have a standard of taking 10% of the width, and that standard still exists. That's just sort of a maximum of the debit that we would take on our flies. Now we're pushing them out even further, sometimes 5, 3, or even 2% of the width. So in other words, we're putting on these 50 wide flies for under $1, maybe even as low as 50 cents. And so then we'll show you the current one, which is a real extreme, and this is going to blow your mind. The average risk to reward here, 1 to 47. 1 to 47. Yet still making money. Putting it so far out of the money, most people say it'll never go out there. Yet, in a single month, with a relatively modest account, $85,000, making almost 5%. And on average, I'll do somewhere between 5 and 10% a month. But win rate, super low, only 43%. But you don't need a big win rate when your average win to average loss is nearly 4 to 1, right? And drawdown is the big thing. Never more than about 1%, right? So screenshot this. Ask your AI to evaluate these stats, and then let it tell you, would I like to be trading this way, right? And if you would, then go down below, click the link, join our school community, and you'll learn how to trade this way. No stress, ever. Anxiety-free trading. You're going to learn solid skills, solid option trading skills. You'll understand exactly how volatility affects your trades. More in, you'll make money and not lose, and you'll compound. So those are all the important things. Starting next week, I'm going to start trading my bigger account and start, just so that people can see that, yeah, this works in, multi-$100,000 accounts, or, it'll be a mid-tier 6-figure account. And we'll trade that and show you the efficacy of trading this way, even in a larger account, and how you can actually make a serious income just from that, right? So let's go back to the big head. So that's all I've got for this morning. Looking for some, just sort of positioning ourselves for that big break. In the meantime, we're putting on trades that are not going to hurt us, but if they turn out, they're going to really move the needle. All right, that's all I've got. I thank you very much. I hope you all have a great weekend. I know I will. Those dog days of summer are here. Take care. Coach Ernie, out.